Almost every asset class today is expensive. Indian equities are not cheap. Global equities are not cheap. Gold and silver are not cheap either. So, where I'm investing in 2026 and why I am changing my portfolio. Let me start with why my thinking has changed. Over the last few years, what stood out to me isn't any single crisis, it is the frequency of disruptions. Geopolitics today isn't background noise anymore. It's directly affecting trade, currencies, energy, and capital flows. US China tensions haven't really eased. Countries are openly competing for dominance. Economic tools are being weaponized more aggressively. You see sanctions, tariffs, etc., that are being levied on countries. Look at what is happening in Iran. Then incidents like Venezuela didn't feel isolated to me. Now there are talks about Greenland. Other bigger countries could also muscle their way into getting what they want. In a nutshell, the global system is becoming more volatile, not more stable. And whenever volatility rises, one thing quietly takes the hit first, and that is currency. For India, this rarely shows up as a sudden collapse. It shows up as a slow and steady rupee depreciation. I consider that to be really dangerous because you do not feel it immediately. But over 10 or 15 years, it can seriously erode purchasing power. And that is what forced me to rethink my portfolio for 2026. I asked myself one simple question. If the rupee continues to lose purchasing power over the next decade, does my current portfolio really protect me? The honest answer was not enough. And that is why you will see two clear shifts in how I'm investing. First, a bigger role for gold. Second, more international diversification. But I'm not going to buy them at any price. Everything I do flows from a few simple rules. First, valuation matters. Not because it predicts returns, but because it tells me how much risk I'm taking. Second, I want hedge, not hope, especially against currency risk. Third, I want liquidity so I can act during corrections and not regret missing them later. Fourth, no FOMO ever. Okay, so how I currently view each asset class. Let me share my high level view before getting into specific numbers. Let's start with Indian equities. I still believe in them when it comes to long term, but at an index level today, I do not think it is cheap. Next is gold. Uh, Very important now, not because prices have gone up, but because currency risk has gone up. And I see currency risk as a sustained issue. Next is international markets. Diversification matters more today than it did a few years ago, both because of the rupee and because valuations outside India are relatively better in certain pockets. So that is the view. Now, let me show you how I will actually act on this. Let's first discuss Indian equities. I love index funds. But I believe the best way to buy index fund is when they're clearly cheap. I do not subscribe to the idea of do the SIP and forget even when the market is overvalued. Doesn't make sense to me. I do prefer staying invested, but in relatively better valued opportunities. So let's look at Nifty PE. On the surface, valuation looks fair, but what you need to understand is low PE PSUs pull the index PE down, while many quality stocks are still expensive. So I'll invest aggressively only when valuations move closer to 20p. Other one is Nifty Next 50. I'm currently adding small amounts because valuations look reasonable, but I'll start aggressively investing once the price to earning goes below 90. Next is Midcaps. I feel they are expensive today, though they have growth, but I feel that growth is already factored in. I'll start adding around when the price to earning is around 26. Next is small caps. I'll wait patiently. I'll add only when fear returns. And that is roughly around 26 price to earning ratio. You do not need to remember these numbers. What matters is how my behavior changes when valuations change. One more important disclaimer is that this is not an investment advice. This is my opinion on the market and indexes. There is one more important point which many people misunderstand. Just because I'm not buying index funds aggressively, it doesn't mean that I'm sitting fully in cash. If I don't get these levels, I'll continue investing in a flexi cap fund, which has a price to earning of around 18 and about 11% exposure to US equities. I will also invest in a couple of multi asset funds. One of them has a higher gold and silver exposure and around 16 to 17% in foreign equity. And I'm also increasing my opportunity fund. I'm also open to selectively buying beaten down individual stocks where the risk reward clearly makes sense. So my money is always working up, just not blindly. Next is gold and silver. So what are my rules for gold and silver? I already hold gold, but at current levels, I'll acquire gold only through multi-asset funds. But if gold corrects by around 15%, that's when I'll add directly through SDBs or gold ETFs. Gold for me is currency protection, not a return chasing asset. Silver is simpler. I'll continue to acquire it via multi-asset funds unless the price becomes mouth-watering. Next is international investing. I'm gradually increasing global exposure. Primarily, I have two reasons. One is rupee depreciation risk, and second is valuation differences across markets. I already have exposure to China, and returns so far have been really good. It has been more than 55%. My thinking is straightforward. China plans in decades, invests heavily in technology and manufacturing, and in many areas does what the US does, but more efficiently. That said, there are real risks as well when it comes to China. There is limited transparency, government intervenes, and then there is policy uncertainty. So this remains as a satellite allocation, not a core bet. US and global exposure will increase gradually, mainly through multi-asset funds and one flexi-cap fund. There are also a few international funds getting launched from Gift City. We'll take a look at that as well to increase global diversification. Next is opportunity fund. This is one of the most important parts of my strategy. Please remember that markets correct 10 to 15% almost every year. So this opportunity fund allows me to add during corrections and consequently improve my long-term returns without me panicking. I will also use this fund to get more gold and international diversification if they come to my desired levels. My opportunity fund comprises of two equity savings funds. One is slightly aggressive, the other one is on the conservative side. I invest equally in both of them. So even if I don't get the opportunity to invest, they can still give me decent returns of around 7 to 10%. Why have I chosen equity savings funds? The reason is because they are tax efficient. I get equity like taxation on these. So instead of slab rate on liquid fund or debt funds, I pay only 12.5% tax, and that too after 1.25 lakh LTCG exemption. And just to be clear, this video is not a financial advice or a recommendation to buy or sell anything. Please do your own research or speak to a qualified advisor before making any decisions. And if you like this video, please do subscribe and do like the video because it helps the algorithm. Thank you. Have a blessed day ahead.